Okay, let's start with the MCQ questions. Question number 1. I think you already gone through the paper. You already answered the paper, right? You know, as the structure, your questions consist MCQ questions, 10 MCQ questions, right? Let's start with the one that is question number 1. Which of the following best describes gap, right? That is generally accepted accounting principle, that is called of gap. The meaning of that: laws relating to accounting requirements, rules and principles that govern accounting, accounting standard and interpretations, principles that underlie accounting standards, right? Then we need to understand what is the meaning of that, the gap, GAAP. That is, the answer would be rules and principles, right? The answer B, rules and principles that govern accounting. And if you have any questions, you can ask or you can text me. Moving into the question number 2, which of the following statement is correct, right? There are 4 statements. 1, an asset is recognized if there is a probable inflows of economic benefit attached to it. Generally, asset will recognize when entity has control over the asset. That's a very important part to recognize an asset. Entity should have control, right? Here they mention that a probability, therefore it won't be. An asset is de-recognized only when an entity loses the control. Yes, asset will recognize when entity has the control. Then de-recognize, you have to remove that asset from the accounts when you lose the control. Therefore, answer B almost correct. Let's see other 2 answers as well. A liability may be measured at a value in use. No, it's present obligation. Items of expenses are recognized in P&L unless an SLFR is considered recognition in OCI to be more relevant. No, generally expenses and income will recognize in P&L, right? Therefore, the correct answer is B. An asset is de-recognized only when an entity loses the control. Yes, because it will recognize when they have the control. It will de-recognize when they lose the control. Moving into the question number 3, 1.3. A customer has bought a legal case against Dias Pereira PLC in respect of faulty goods. 31st December 14 or say 24. The case has not concluded, and lawyers advise company that there is a 60% chance of losing the case, right? In which case payment is 250,000 is the most likely outcome. The case was settled between 31st December and that is an event occurs after the reporting date, right? And Dias Pereira was required to pay 210,000 to the customer. What amount, if any, is reported in the published financial statement as a provision as at 31st December 2014? You know the financial statement date, reporting date is 31st December. The case was finalized before financial statement approved for issue. Therefore, that events come under events occurring after the reporting date, right? You know that lawyers clearly said, advise that case going to be lost. There's a 60% chance. If they lost the case, they have to pay 250,000. But with the 60% chance, it would be 210 because of the probability, right? You know they have to make a provision for that because you know provision is a present obligation. Amount and timing is uncertain, right? Therefore, you have to make the provision for 210,000. That is the best estimate of the management. If lawyers advise the case is going to lose, means you will have the present obligation, right? That is the fundamental of this question. If lawyers clearly mention you are expert, that is who expert in legal cases, said clearly it's going to be loose, that means you have to pay penalty. That means there is a present obligation to pay penalty, right? Now you have to make the best estimate. That best estimate will be the total amount of penalty into the probability of losing. 250,000 into 60%, it's become 210,000, right? No, 60%. No, the case was settled between 31st December and the date on which the financial statement were approved for use. The aspirant was required to pay 210,000, right? Now they have to pay 210,000. Financial statement not yet finalized before approved for issue. They exactly know the value now. Therefore, they have to make 210, right? That's why answer would be 210. This point is very important. The case was settled, right? 31st December, and on which financial statement approved for issue. During this period, it was settled and they ordered to pay, required to pay 210 to the customer, right? This is the amount. Now you clearly know before the finalization of accounts, you have to pay 210. Then you can easily make the provision at 210. Answer C. Question 4. During the period between the reporting date and the date on which financial statements of Kalugala Tea Limited are approved for issue, again in between reporting date and the financial statement for approval, that is events occurring after the reporting date, the following event occurred. A fire at one of the 10 plantations. A management decisions to pay one-off bonus 60,000 to key members of staff in respect of performance in the past year. Right? Those are the two incidents. Which of these is an adjusting event? Now, a fire occurred after the reporting date, but before the financial statement approval for issue. Events occurring after the reporting date, but that fire occurred after the reporting date. It's a new incident. It won't produce additional events about the reporting date. Fire is a new event occurred after the reporting date. Therefore, a fire don't want to adjust it to the financial statement because the plantation was at 31st March or 31st December at the reporting date. There wasn't any fire case at the reporting date. Thereafter, it was arise, right? Therefore, no need to adjust that fire case. Second thing, the bonus, right? When you make the bonus will be it become an eligible payment or to the employee's eligible receipt once it approved. It was approved or the decision taken after the reporting date. Therefore, in question 4, which of these is an adjusting event? Neither of them, right? That would be the answer. Answer A, because both incidents arise after the reporting date and those events will not generate any additional events, additional evidence to the items or the numbers reported at the reporting date. Now, for an example, if you take a solvency of debtor, yes, it's provide additional evidence to the amount of debtors reported at the reporting date. Because at the reporting date, you want to estimate what would be the possible bad debt or impairment. After the reporting date, when a debtor went bankrupt, yes, it is an additional evidence to adjust your debtors. But a fire is not an estimate to be made at the reporting date. It's a new incident. Again, bonus decision. It's a decision taken by the management after the reporting date. Those two events are new events, not provide any additional events to the reporting date. Therefore, no need to adjust one or two, right? Moving into question number 5. A company issued 25 key members of staff with 1,000 share option each on 1st August 2014. You know, this is share employee share option plan. On this date, the value of each option was 6, right? The staff members will become entitled to the option if they remain in the employment of the company on 31st July 2016. That is the vesting period, right? Employee share option plan. There are some conditions to satisfy to become eligible for this share option plan. Here they have a condition, they have to work with the organization till 31st July 2016 from the date of announcement, that is 1st August 2014. During the vesting period, they have to be at the organization. At 1st August 14, the date of they announce it, it is expected that all members of staff will remain, right? At the date they announce, they believe all members will be remaining at the organization. But 31st July 2015, exactly after 1 year, it is expected that 2 will have left by 31st July 16. Now, after 1 year, they believe out of 25, 2 members will leave. What expenses is recognized in the year ended 31st July 2015, right? Now, generally, 25 employees, 1,000 share options, right, per employee, then you can multiply by that one, 10,000 share options for each, 25 key members, right? Fair value is 6. Now you can multiply those numbers together. There are 25 employees. Each employee gets 1,000. The fair value is 6, right? Now, at the beginning of the announcement, the value would be this much, right? Going back to the question, yeah, 25,006, right? Now, this is the total value. This was announced in 1st August 2014, right? Then you have to recognize first financial year will be ended 31st July 2015. Then vesting date will be 31st July 2016. I think they have to be at the organization only for 2 years as per the questions. Yeah, 2 years as per the question. They have to be at the organization, right? Now, this expenses should be recognized over 2 years. Therefore, you have to divide this by 2, right? And the problem is, end of the first financial year, they believe 2 members out of 25 will leave. Then do you want to allocate for them? No. You want to allocate only for 23 people, right? Once you reduce this into 23, the value become 69,000, right? Then for the first year, you have to recognize 69,000. cost in your P&L as a provision, right? Therefore, let's see the answers. In this question, answer A, question number 5, answer A says 69,000, right? I will explain it again for you. 25 members were there, 1,000 share options, 6 is the fair value per option. Total value would be 150,000. Each year you need to recognize 75,000 and 75,000. But you realize 2 is going to leave, then the total become 23. Then per annum you have to allocate only 69,000, not the entire 75,000. Therefore, answer would be 69,000. Answer A for question 5. Then moving into the question 6. On 1st March 2014, a subsidiary of Dambulla Trading PLC meets the criteria to be classified as held for sale. 1st March 2014. They meet the criteria as held for sale. At this date, the subsidiary has a carrying amount of 90 million and its fair value 120 million. Cost to sell are expected to amount 10 million. Subsidiary makes a forced tax loss of 6 million in the year 31st December 14 and 5 million of which arose after classification as held for sale. Right? What single amount must be disclosed in the statement of profit or loss and other comprehensive income in respect of the subsidiary? Assume that is a discontinued operation. Right? Now, generally, when there is a asset or disposal group held for disposal, it should be recorded at the lower of carrying value or fair value less cost to sale. That's a requirement in SLFRS 5, right? Now here, uh, the post-tax profit or loss of the subsidiary for the full year, right? Then that is how much? Post-tax loss 6 million. That's important information, right? This is 6 million, 5 million of which after 5 million of which arose after classification as held for sale. What single amount must be disclosed in the statement of profit or loss and other comprehensive income in respect of the subsidiary, assuming that it is a discontinued operation, right? Now, when there is a asset to them here, disposal group held for sale, when you are going to sell a subsidiary, it has to be completed within 1 year. Active plan should be there, active buyer should be there. There are some conditions in this standard. Now they decided, assume all these satisfied, right? Now you need to record what you have to record when you decided to dispose a subsidiary. All the income, expenses, and its profit has to be separately recorded in the P&L. In balance sheet also, those information you have to separately mention as discontinued operation, right? Now here, once they decided to discontinue, they ask what is the amount should be presented in the P&L or other comprehensive income, right, in respect of discontinued operation. Now the subsidiary makes post-tax profit, post-tax loss 6 million 31st December 14, right? Out of that 5 million after the classification. Now they ask how much you have to separately present it in the face of the P&L or other comprehensive income, saying that this is arrived from discontinued operations, right? Entire 6 you have to present, right? The fundamental is this: when you have a subsidiary, you will add line by line their assets and liabilities in the consolidation. all income and expenses in the consolidation in P&L. You will console. But when you decide to discontinue, dispose the asset, all the net profit and assets and liabilities, everything you have to separate it from the main operations and mention this will be discontinued in future. That's the requirement in the standard. Now, this organization reported post-tax loss 6 million for the recent concluded financial year. Therefore, entire value you have to reflect as a discontinued operation, because this year, yes, is 6 million loss, but next year it won't happen because you are going to dispose it. Therefore, that information has to be reported to the users saying that this is a, an operation going to be discontinued, but this year, yes, we have a loss of 6 million. Therefore, answer would be 6 million, right? Has to be reported on the face of the P&L as discontinued operation. Now, moving into the question number 7. Let's see if you have any questions here. Yeah, a lot of questions are there. People said that paper is not visible. Is that true? I am already shared the screen. Again, I have shared the screen. Now, please tell me, can you see now? Okay. Okay. Can you just tell me whether you received the paper before this presentation through mail or some method? Okay. Okay. Did you answer the question paper? Right. Thank you. Thank you. Okay. Let's move into question number 7. Right. Viracon Water PLC has 75% investment in Viraquatics Limited, which is turn has a 60% investment in Westwater Limited. Mia Pereira is the sales director of Viracon Water PLC, and her husband is the chief operating officer of Hippola Homes PLC. To which companies is she related? That's the question, right? Viracom Water PLC has 75% investment in Viraquatics Limited. Now, Viracon Water PLC related to Viraquatics Limited. Yes, those two companies are related. Vichy Turn has a 60% investment in Westwater Limited. Now, Viraquatics Limited also has 60% investment in Westwater Limited. Right? All three companies are uh, related companies, right? Then under that, Viraquatics Limited, then under that, Westwater Limited. All three companies are parent, subsidiary, and sub-subsidiaries. Mia Pereira is the sales director of the PLC company, and her husband is the chief operating officer of Hippola Homes PLC. To which companies she related? Now I will take this draft, right, in an Excel sheet. I think it's easier, then you can easily understand. Viracom, that PLC is the parent company. It has 75% of another company, Aquatics, right? Then it has 60% of wastewater, right? Now this is the ultimate parent, then subsidiary, sub-subsidiary. All these three companies are related companies, right? No doubt there. All these three are related: parent, subsidiary, and subsidiary. Then there is a lady called Mia Pereira, lady or gentleman, the sales director of the PLC, right? Now, Mia Pereira is the sales director of this company, director of the parent company. Let's say here, Mia Pereira, director of this company. That is, you know, who are the three people become related person to a company. You clearly know after going through the LKS 24, chairperson or person who jointly control, person who right, person who control or jointly control. That means chairman or whatever become related person. Then significant shareholders, right, are related parties. Then key management personnel, KMPs are related parties, right? Now Mia Pereira, this lady is a key management person, right? KMPs, because she's that Mia is the sales director there, right? Person who control or jointly control, significant shareholders, and key management persons are the related person. Then their close family members are the related persons to the entity, right? Now there is another company outside to the organization, right? What is that company? Sorry, Hippala Homes. This is the other company, Hippala Homes, right? In this company, her husband is the CEO. Mia Pereira's husband, Mia's husband is the CEO. CEO is a key management person of Hippala company, right? Now we have to see for which company. Question is, to which company she is related, right? To which company she is related. Now let's see. Now she is a director of PLC. Therefore, all subsidiaries she become related, no doubt. Directors of the ultimate parent automatically become director related to the companies under the parent. Therefore, water aquatics and wastewater automatically may become related. For therefore, all the four companies she is related. Now, Mia's husband is a key management person of Hippologons. Now, Mia's husband is related to this company. Why? As a close family member of key management person, right? Therefore, she has a relationship with Hippologons also. Now, let's see the answers. She is related to which company she is related to Viracon, yes. Viracon Water PLC and Hippala, yes. Viracon, all of the companies. The answer would be all of the companies. I think it's clear, right? If you go to the LKS 24, it's clearly mentioned who are the related person and who are the related entities. That's why I have used this Excel sheet also here. Then you can easily understand the relationship. Okay, moving into question number 8. Basic earning per share for 2014 of DA Silva Industries, 134 cents. The tax rate applicable to the company for the year was 28% and average share price 8.5. The company also has in issue options to buy ordinary shares 8.8. Rupees 3 million loan stock convertible at rate of 2 share per LK's 30 loan stock. The finance charge in 2014 in relation to the loan stock was 190,000. Which of the potential ordinary shares should be taken into account in calculation of the diluted earning per share? I will give you the general answer for this one first. When there is a share option, right, that share options will create future ordinary shares. Therefore, share options already issued become potential ordinary shares. That's a normal theory, right? Employee share option plans. You know, share-based payment, basically we have share appreciation rights and share option plans. Share option plan is an example for equity settled share-based payment. Share appreciation right is an example for cash settled share-based payment. Share appreciation right in future will be settled in cash. Therefore, it won't issue any ordinary share, right? But share option plans, right? Share option plans will issue ordinary shares in future, right? Then share options plan should be considered as potential ordinary shares to calculate diluted earning per share, right? Number two, contingent consideration agreed by issuance of shares. Sometimes acquirer, when acquire companies, will agree to pay their own shares to the seller. A will go and buy company B, right? Then A has to pay cash to the B's shareholders. Okay. But sometimes there are some contingent consideration, deferred consideration that share, buyer agree to issue their own shares in future subject to some conditions, contingent consideration. If there is a contingent consideration in shares in future as a result of business acquisition, it generates future share issues. It's a potential ordinary share should be considered in diluted earning per share, right? Number three, convertible debentures or loan stocks. Definitely, it will generate future ordinary shares. Now, here they gave us options to buy ordinary shares. This is not a share option plan. Share option plan will issue shares. Here, option buy to shares. Buying shares means it will buy only existing shares. There won't be any future share issue. That option gives right to buy existing shares, but share option plans will issue shares. Here there is no share option plan, right? Therefore, we can't go with that first bullet point. The number two, loan stock convertible at a rate of 2 share per 30 loan stock. Yes, it's a convertible loan stock. Definitely, it will convert it into ordinary share. Then company has to issue new shares in the future day. Option to buy share, they will buy existing share. There won't be any share issue. But convertible loan stocks will issue shares in the future day. Therefore, you need to consider this loan stock in calculation of diluted earning per share. Then answer would be C, the loan stock. In question 9, Which of the following need to be disclosed in accordance with LKS 7? Which of the following need not to be disclosed? Right? From the sales of property, plant, and equipment, depending on whether the sales has achieved either a profit or loss, restrictions on use of cash equivalents, available undrawn borrowing facilities. A bonus issue, LK7 is statement of cash flow, right? If there is a bonus issue, there is no cash inflow, then number of shares will increase, but no cash coming to the business. Those things has to be disclosed, saying that there is no cash flow, right? The restriction of use of cash equivalent, you have to disclose. Available undrawn borrowing facilities, you have to say, yes, I can use this facility. You have to disclose those things, right? They're asking which of the following need to be disclosed, need not to be disclosed, right? Be careful in the exam. Need not to be disclosed, right? Here, not to be disclosed in LK7. See, question, the answer be a split between cash proceed from the sales of property, plant, and equipment, depending on whether sales has achieved either profit or loss. So in cash flow statement, you have to say how much the cash received from disposal of property, plant, and equipment. How much cash paid to acquisition of property, plant, and equipment. That's the requirement you have to show. Therefore, this split is not a compulsory requirement in LKS 7. Answer would be B for question 9. Right? Then final question, question 10. A company constructed an investment property at a cost of 4.2 million during the year ended 31st December 2011. This amount included 100,000 architect's fees, 20,000 import tax related to specific slate use on the roof, 40,000 of material and labor costs that were wasted due to the project managers reading the architect's plan incorrectly. At what amount is the property initially measured? Right? The investment property at a cost of 4.2, that should be there. Generally, that is the construction cost. But the problem is there are architectural fees, import taxes paid, and 40,000 wasted material. At what amount is the property initially measured? As per this standard, it should be measured initially at cost. Right? Now, architectural fees should be a part of cost, because without that you can't construct the building. Then taxes paid on material imports, right, is part of the cost, because these are not reimbursable taxes. This is not like VAT. You can't reimburse this. You have to include it in the cost. But waste material is the question. Waste material won't take part of the construction cost. Therefore, total 4.2, right? But you have to eliminate this 40,000, right? Once you eliminate this 40,000 from here, it will be 4.160, right? This would be the answer. That's all about the MCQ questions. Now let's move into let's see how long we'll take to discuss the paper. Approximately, I don't know. That's the answer, right? Then question 2. Let's move into the question 2. It's SME questions, right? In this question, my advice is to discuss the question, the requirement first. Then you can read the question thereafter. Apply the requirement of SLFRS for SME to above A, B, and C in order to determine how the raised concern need to be reflected in the financial statement. Okay. Now there are three cases you have to answer using SLFRS for SME, right? SYZ Limited is a plastic bottle manufacturing company that prepared financial statement according to SME standard. The Saman Pereira is the chairperson of XY company. During the finalization of the year-end draft accounts, the following concerns were raised by Nihal Silla, finance director of the company. Saman is the chairperson. Nihal Silla is the finance director of the XYZ Private Limited. Disclose of transaction between PQR. PQR and company is a partnership, right? It's a partnership. That partnership made some transaction with this SYZ company that provide plastic materials for production. The total amount of this transaction, 2 million. Mrs. Ruani Silva, who is Mr. Nihal Silva's wife, is a sleeping partner, and Mr. Gamage is the acting partner. Now, is XYZ company make some transaction with this partnership, that is PQR partnership. Finance director of the XYZ company, his wife is a sleeping partner, not an active partner of this partnership, right? Now we have to see whether we want to disclose it. Generally, Mr. Nihal Silva is a key management person because he's a director of XYZ. Then his close family members also become related. But this is a partnership. According to the sections given in SME booklet, related party transactions, right? If you go to the section 33.2, right? This is a partnership. The sleeping partners of a partnership doesn't have control over the partnerships. Only active partners has control over the partnership. Therefore, sleeping partners, even she's a partner, she's a sleeping partner, no control. Therefore, this is no need to disclose as a related party transaction. That's the requirement. Because that section 33.2 clearly mentioned, if the other company is a partnership, but that partner is a sleeping partner there. Sleeping partner means she's not involved in any operational or financial activities there. She's just a partner. Then she doesn't have any control or decision-making power over partnership. Therefore, no need to consider it as a related party transaction, right? Then B, due to the fire that occurred in January 2023, the plastic stock was burned and caused environmental damage. The authorities have filed a lawsuit against the company. As of 31st March 2023, it is probable that company will have to pay 4.5 million to the authorities. Definitely, there is a probability of payment of this penalty. Therefore, this should be recorded as a provision, right? In the financial statement, it has a current obligation. Addition to that, insurance company approved they are going to pay 4 million as compensation for this damage. Now you have to recognize a provision 4.5 as a provision because you have a current obligation to pay this. Now your question whether you can recognize this insurance claim as an asset. Yes, because look here, insurance company approved a claim. That's very important point. They approved the claim. Then it is a receivable. You can recognize it as an asset, as a receivable, right? But very important, you can go to the standard, SME standard and see, right? That you can refer section 21 onwards, right? It's clearly mentioned in the balance sheet. You can't offset this liability and receivable balance. Liability is 4.5 million payable, that provision, and receivable balance is 4 million. You can't offset. You have to separately record at the liability and the asset, right? But when you record this in the PNL, That is, that 4.5 million liability will be an expense in the P&L, 4 million will be a profit in P&L. That can be offset and recognized only 500,000. Right? I will repeat it. This 4.5 has to be recognized as an expense, P&L debit, payable credit. Then 4 million you can recognize as a gain, receivable debit, P&L credit. In balance sheet, asset and liability should be recorded separately, but P&L, right, you can offset. Simply, in P&L, you can offset and recognize the net, but balance sheet, asset and liability should be recorded separately. That's the requirement. Then, see, it's a company policy to carry forward unused annual vacation and sick leave for the period of 1 year. Mr. Kalhar, the company's accountant, has 5 unused total leaves. As per the employee benefit, unused, if there is payment for unused leaves, you have to make a provision at the end of the period because it can be utilized in next year. Therefore, in this case also, you have to make a provision for this unused leave based on the probability of utilization in next year. If he is going to utilize the entire in next year for unused leave, you have to make a provision in your financial statement. It is according to the employee benefit that is available in your SME standard paragraph 28, right? When you advise, my advice, when you write the answers, my advice, you have to refer the relevant section first and advise thereafter, right? That's why I'm telling you the paragraphs, because in your answer also you have to, because here apply the requirement, you can see apply the requirement. That means you have to refer the paragraph first and then advise, right? At least a summary of the paragraph you have to mention. Okay, now we are moving into the question number 3. It's about fair value measurement question, right? Directors of XYZ Limited Public Limited Company have seen many different ways of dealing with the measurement and disclose of fair value assessment, fair value of asset liabilities and equity instrument. They feel that this reduces comparability among different entities' financial statement. They would like advice on several transactions where they currently use fair value measurement, as they have heard that the introduction of SLFRS 3 fair value measurement, while not interfering in the scope of fair value measurement, will reduce the extent of any diversity and inconsistency. Now look at the case. XYZ Limited owns several farms and also owns division which sells agricultural vehicles. It is considering selling this agricultural retail division and wish to measure fair value of inventory of vehicles for the purpose of sale. 3 markets currently exist for the vehicle. XYZ Limited has transacted regularly in all 3 markets. At 30th April 2015, XYZ Limited wished to find the fair value of 100 new vehicles, which are identical. The current volume and prices in the 3 markets are as follows. Now, this is a question relating to IFRS 13, SLFRS 13 fair value measurement, and this gives us the information about the selection of market, right? As per the SLFRS 13, the market would be the principal market to get the fair value. If the information of the principal market absent, you can go for the most advantageous market. That's the requirement. Everything, all the paragraph, you have to write it down, right? I am explaining to you, but when you answer in these things, you have to write it down. Answer will be shared with you by CS Sri Lanka, but I will explain, right? As per the SLFRS 13, fair value, you have to write down the definition of fair value. Then you have to say fair value has to be right from the market. Market First, you have go for the principal market. Principal market is the market where most number of transaction record, right? If there is a absence of principal market, information about principal market, then you can go for the most advantageous market. Then you have to define the what is most advantageous market. Most advantageous market is the market where company can get the highest benefit, right? Then how we can calculate the benefit? Benefit equals selling price minus transaction cost minus transportation cost. That's how you have to calculate the benefit. Why we need to calculate benefit? In calculation benefit, you will reduce both transport cost and transaction cost from the selling price to calculate the benefit. The highest benefit is the market we call most advantageous market. But keep in your mind, you have to go for the most advantageous market if there is an absence in principal market, right? Then that standard clearly mentioned further, company no need to have any past experience in that market. They don't want to have any past transaction history with those market. Only what they want, they must have access to the market. No need to have past experience in that market. No need to have any transaction you already made in that market. But you should have access to that market. Here they mention they have regularly transacted with all the market, but that is not compulsory. They should have access to the market in the current situation. Okay, now they selected 3 markets, Europe, Asia, and Africa. Now, principal market we have to select. Principal market will be the market where highest number of transactions taken place. Historical volume of vehicles sold by XYZ, that is not important to us. We need highest number of transactions in the market. That is the total volume of transaction, right? This is the column you have to select. Total volume of transaction. Out of that, Asia will be the market. Principal market will be the Asia because it has the highest number of transactions. Then you will select Asia as the principal market, right? Then you have to write down, yes, Asia has the highest number of transactions, 150,000 transactions. Therefore, we will select Asia as the principal market. Based on the Asia's information, the fair value would be selling price minus, you have 2 costs, transaction cost and transport cost, right? Selling price minus transport cost. You are not going to reduce transaction cost, right? That is very important. Selling price is 38,000 in the principal market. Here, transport cost is 700 rupees in the market. Then that is the rule, right? When you get the fair value, price minus transport cost. I will tell you the reason. When you buy a car in Japan, it has a fair value. The same car, when it's come to the Colombo market, it has an additional price because of the transport cost. Transport cost is not a part of the fair value, therefore you have to eliminate the transport cost when getting the fair value, right? Therefore, fair value would be 38,000 minus 700, that is 37,500. Total number of vehicles 150. Then you can multiply 37,300 by 150 units. Then total fair value become 5.595 million, right? Then you have to say, in the case of absence of information in principal market, company can go for the most advantageous market, right? Then you have to say, what is most advantageous market? Most advantageous market is the market where company can get the highest benefit. How we can calculate the benefit? Selling price minus transport cost minus transaction cost. Don't mix this, right? When you get the fair value, selling price minus transport cost. But when you get the highest gain, to identify the most advantageous market, both costs you can deduct. Therefore, we can calculate most advantageous market. Let's see 3 prices, 40,000, 38,000, 34,000. I will quickly record here 40,000, 38,000 and 34,000. Then let's take transaction cost 543 543. Then let's take transport cost 476, 400, 700. Sorry, 400, 700, and 600. Now gain. To calculate the gain, in order to identify the most advantageous market, you need to reduce both expenses from the price, right? Now you can see what is the highest gain. That is 39,100. That is Europe market. Most advantageous market, which is that giving highest benefit to the entity, that is Europe market, first market, right? Going back to the question, Europe become the most advantageous market in case of principal market not available, right? Then you have to calculate the fair value. How we calculate fair value? Price minus only transport cost, right? Again, same thing. Price minus only transport cost. Price is 40,000, right? Transport cost is 400 in this market, right? Now you have to calculate the fair value per vehicle, 39,600, right? 39,600, that into 150 vehicles. Then you can get the total value. I think it's clear, right? Uh, you have a recommended answer also. I'm checking it because whether they use the both calculations. Right, those both answers not available here, right? I will tell you how to answer this. Give me 1 minute. I have an answer I have prepared for this. I will show it to you, right? Give me 1 minute. I will take that answer quickly. Sorry, it's difficult to find out. I will tell you how to write answer completely, right? Like this. First of all, you have to write down, note down, right? What is the definition of fair value? It's available in paragraph 2 of the standard, right? Fair value measurement is a market-based approach, not an entity-specific approach. That sentence has to be there, number one, right? Then in paragraph 2, at the end of the paragraph 2 of the standard, I can clearly mention the definition of the fair value. Fair value is a value in between two market participants where asset is transferred or liability is settled at a given time, at a given condition. Everything is there. You have to write down those things. Then you have to say about the market. Then fair value has to be derived from the principal market first. Principal market is the market where I have highest number of transactions. In the absence of principal market, we can go for the most advantageous market. Most advantageous is the market gives highest gain to the entity. Gain will be calculated after deducting both transaction cost and transport cost from the selling price. Then you can go for the answer to the case. Then you can write down in the given scenario, Asia market can be considered as the principal market because it's recorded highest number of transactions. If you take Asia market as the principal market, its selling price is 38,000, transport cost is 700. Therefore, its fair value will be 37,300 into 150 vehicles. However, if there are any absence of principal market, company can go for the most advantageous market also. According to the given information, most advantageous market would be Europe market. As we calculated earlier in the Excel, you can remember Europe market, since it gives 39,100 gain compared to the other two markets. If you selected most advantageous market, that Europe market, again fair value would be 40,000 minus transport cost of 400 into 150 vehicles, right? Both things you have to explain in the answer, right? First you have to advise according to the standard, then you have to say what is the principal market, then you have to say what is the most advantageous market, what is the value in principal market, what is the value in most advantageous market. Everything you have to explain here. Then you have to say the calculation made by the accountant here is wrong, right? Because first priority goes to the principal market, then you can go for the most advantageous market. That's the requirement, right? Then the second question, earning per share question in question 3b. Urijala Sugar PLC reported return profit of 230 million in the year 31st December 2016. 230 million is the profit. The company has the following shares in issue. Ordinary shares 10 million, 5 million redeemable preference shares. Redeemable preference share here according to the LKS 32 paragraph 16. If it is redeemable, it's become a debt instrument, right? If it is a debt instrument, the dividend paid on redeemable preference share, it's a debt instrument, will be considered as a finance cost, right? That is already deducted because here we have return profit, that is profit after tax, 230. Therefore, we can tell that the dividend to be paid on this redeemable preference shares already deducted as the finance cost because it's a debt instrument. Then you have 4 million irredeemable cumulative preference share. Irredeemable shows characteristics of an equity instrument because there is no obligation to repay, right? Therefore, generally, those are not deducted as finance cost. Therefore, to calculate basic earning per share, you have to reduce preference share dividend on this irredeemable preference shares from the profit after tax. Generally, if it is a irredeemable preference share, right, that dividend will be deducted at the statement in changes equity, right? This first one already deducted as the finance cost because this is a debt instrument, but this is not deducted yet. It will be deducted at the changes in equity. That preference share dividend should be deducted from 230, that is profit after tax, before calculation the earning per share, right? Now 230 is the profit before deducting dividend for irredeemable cumulative preference shares. Then dividend for that 4.5% per annum, 4.5% on 80 million would be 3.6 million. Then after deducting that 3.6 million, your profit attributable to the ordinary shareholders become 226,400,000. Like here I will calculate for you. 230 million minus 4.5% dividend on 80 million. Very simple, right? Then after deducting only irredeemable preference share dividend, it's become 226.4 million. Has to be divided by 10 million ordinary shares to get the earning per share. When you divide 226.4 million by 10 million shares, your earning per share become 22.64, right? If I calculated here, profit after tax 230 million, right? Redeemable preference share dividend already deducted as finance cost, therefore no need to deduct it again. But you need to calculate preference share dividend that is irredeemable, right? That is 4.5% on 80 million, right? 4.5% on 80 million, it's become 3.6. Then profit attributable to ordinary shareholders will be this much. The number of shares 10 million. Earning per share will be profit attributable to ordinary shareholders divided by number of shares. Because there is no share issues during the year, therefore opening shares can be taken as the shares of the company at the end of the year as well. Right? Now we are moving into question number 4. Ethics question. Let's see, is there any comments or questions? Answers will be shared by CS Sri Lanka with you, Buddha, don't worry. Right? So are we getting the, yeah, CS Sri Lanka will share with you answers. I will tell them. Okay, let's go into the picture number 4. Nuan is the finance manager of Elegant Designs Private Limited, which sells designers' dresses. Somebody asked about that previous question, that fair value measurement question, right? I will tell it again here. Somebody asked me to calculate the principal market. To calculate the principal market, no need to do any calculation, Putha, because principal market is the market where highest number of transactions taken place in the market. This is the total volume of the vehicle sales. Therefore, highest number of transactions taken place in Asia market. You can see 750,000 is the highest. Therefore, Asia is the principal market. Then fair value will be 38,000 minus transport cost of 700. That's all. Right? That is into 150 vehicles. You need to do the calculations seriously for the most advantageous market to get the highest benefit. Otherwise, highest number of transactions taken place, that market is the principal market. right? Okay, let's move into the question number 4 quickly. One is the finance manager of Elegant Designs, which sells designer dresses. The following situations are currently present in ED, right? It was noted that there is a significant impairment of debtors which should be accounted for in the books of account. One is aware that this will have a significant impact on profit of the company and the bonus entitlement of the employees, including him. One has the authority to create supply in the system. The general manager asked Nuan to create a supply in the system, but Nuan is aware that this supply is bogus. The general manager has threatened Nuan, saying that he will provide negative feedback on his performance to the board of directors if he does not create this supply in the system. Discuss one threat each of the professional ethical behavior faced by Nuan as a result of situation given by A and B. State two fundamental principles of professional ethics for accountants. Okay, that is general thing. Okay, what is A? It was noted that there is a significant impairment of debtor which should be accounted for in the books of accounts. No one is aware that this will have a significant impact on the profit of the company and the bonus entitlement of the all employees, right? Including him. Now, there should be an impairment. It should be recorded in the P&L. Then profit will come down. When profit will come down, bonus will come down. It will affect to the Nuan as well, right? If Nuan want to not to record this impairment loss in the P&L to get more bonus to him, there is a self-interest to Nuan. If somebody do something wrong, unethical, to get his personal benefit, that's a self-interest threat. He has interest on his bonus, not the company's real profit. Therefore, in A, there is self-interest threat. In B, general manager threatening him to do so. No, it's wrong. But general manager asking him to do so. When somebody threatening to you do something, unethical thing, there is a intimidation threat. When somebody threatening you, it's called intimidation threat. Therefore, A, self-interested, B, intimidation threat. State two fundamental principles. You know what are the fundamental principles of ethics: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Right. Let's move into the part two. Malinga worked as an assistant audit manager in a small audit firm. He qualified as a chartered accountant recently and joined FH Holding PLC. The chairman of the company has requested Malinga to carry out complex business valuation based on which he will decided to acquire a company. Malinga has no previous experience, right, in performing business valuation, and he is not confident that he can perform the task to meet the required standard. Explain fundamental principles of professional ethics that Malinga need to consider when carrying out the business valuation. If Malinga knows he doesn't have enough competencies to do so, to carry out a valuation, if doesn't have experience to do so, right, he can't accept that job, right? That is very important because every chartered accountant requires to carry out his job in professional competence and due care. If he accepts this job without having any experience or knowledge, right, he has a threat to professional competence and due care, right? Therefore, what Malinga wants to do, Malinga should not go for the valuation job. He must advise to take an expert to do so who has experience and knowledge, right? But depend on the continuous development of the accountant, he can work on it and learn how to do that and develop himself. But without having experience and knowledge, you can't accept. If you accept it, you have threat to professional competence and due care, right? It is very important that ethics clearly mention the company you employ expects reasonable service from you. They expect you will use your professional competence and you will work with due care to get the benefit to the organization. When you don't have that knowledge or experience, you can't accept it and do it. Then there is a threat to professional competence and due care. Right? Then finally, the code of ethics identified a number of threat to its fundamental principles. Jake is responsible for preparing the warranty provision as part of the year-end financial statements. Jake's manager, the finance controller, has reminded Jake that the warranty provision will impact on the profit related to pay bonus that both he and Jake are entitled to receive. The finance controller then mentioned his own holiday plan and that he need the bonus to pay for it. Right? Identify and explain ethical threat is Jake facing. Now, if again the same question in question 1, if you want not to make the higher provision, the real provision in the PNL to get higher bonus, when they make the provision, profit will come down and bonus will come down. If Jake personally believe if I charge this expense, my bonus will come down, therefore I don't want to make this provision, there is a self-interest state, right? If we purposely do that. If Jake has to do that because his finance controller asking him to do, right? Forcing him to do, threatening him to do, there is an intimidation threat at well. Because somebody threatening to do so. Then there's an intimidation threat. If Jake's by himself think and do it to manipulate profit, self-interested. If Jake do this because of the finance controls influence, that is intimidation threat. Through these two threats, right, he violated the objectivity, because when you prepare financial statement, it has two fundamental qualitative characteristics: relevance and faithful representation. What is faithful representation? It has three sub characteristics: completeness, neutral, and free from error. It should be neutral. Jake can't think about his side or his finance controller's interest or shareholders' interest or employees' interest or whatever. He can't think about anything. He must take neutral position and prepare a financial statement to give an independent view on the financial statement. Right? To make that, you should have objectivity, the quality of objectivity. If you do this for your personal benefit or because you do this because of the influence coming from the finance controller, you will lose the objectivity. Right? Those things you have to explain in the answer. Now you can tell like this: if Jake is going to make lower provision to manipulate the profit and get more bonus to him, there is a self-interest rate. If Jake going to reduce the provision to have higher profit and higher bonus because of the finance controllers influence and threaten, there is an intimidation threat. From both threats, the objectivity will be impaired, because when preparing financial statement, accountant should have the objectivity to give neutral view, independent view of the financial numbers, right? Therefore, the Jake should conduct a reasonable assessment of the provision and make it without manipulating the profit. That's the requirement. When there is an intimidation threat, what you have to do, you have to report to the next superior, a finance controller threatening you. You have to report to the finance director regarding this threat. If finance director not asking you, you have to go for the next level. That is the audit committee of the organization. You have to inform. Even if they also involve, then what you have to do? You can't work there. You have to resign, right? You can't be there further. That's the safeguards you have. Yes, you can get this record as well because here Sri Lanka recording the video, that discussion. Okay, question number 5. Interesting question, ratio calculation. Right, there are two questions. Let's quickly go through. Superplastic PLC is a company involved in manufacturing and selling industrial plastic product to the local market. The management is concerned about the operating efficiency of the company. Statement of profit or loss and other comprehensive income of Superplastic PLC for the past 2 years given below. Right? Revenue, cost of sale, gross profit, operating expenses, finance cost, profit before tax, taxation, profit for the year for 2 years in thousand. Following ratios and information have been ascertained from the financial statement of the company and industry statistics. Right? Gross profit ratio calculated, increase in average price level over previous years, operating margin, fixed asset turnover, industry average also there, sales, capital employed, current ratio, closing debtors, closing inventory, credit settlement period, quick asset ratio. You are required compute the following ratios for both years: return on capital employed, interest cover, inventory holding period, debt collection period. Return on capital employed, total capital employed would be the debt, equity and non-current liabilities, equity and debt capital, right? Here they have mentioned sales on capital employed, sales on capital employed, sales divided by capital employees is 1.4. Once you divide sales by capital employees, it's become 1.4, right? Now here you can see sales 29,000, 20,000, right? 790 sales. Here sales divide capital employed 1.4. Now you can see easily how to calculate capital employed, right? Sales has to be divided by this answer. Let's quickly calculate. Sales divided by capital employed equal 1.4. Then sales equal sales equal 20,790, right? Am I correct? Sales how much? 2790. Yeah, 2790. 20,790. Then capital employed would be this divided by 1.4. Sales divided by 1.4. Right? Then capital employees become 14,850. Now they ask return on capital employees, that is before the finance cost, that is operating profit, profit before tax plus finance cost, right? Profit before tax plus finance cost is the operating profit. Operating profit divided by capital employed is the return on capital employed, 3,120, 920, right? Now here you can calculate profit before tax, then finance cost. Profit before tax is 3,120, 3,120. Finance cost is 920, right? Total become 4,040, right? Now return on capital employed, that's called ROCE, right? That is return divided by capital employed would be 27.2%, right? As a percentage, 27.2%. 2, right? Now same thing you can do for the last year also, right? Take sales on capital employed, take sales and calculate capital employed, then take profit before tax and finance cost, add together, right? And you can then calculate return on capital employed. Because since capital employed include debt plus equity, therefore here you have to add back the finance cost to the profit before tax. Oh, this called operational profit. This is called operational profit. Some P&L operational profit will be given. Here not given, therefore you have to add back finance cost to the profit before tax. Right? Then they ask you to calculate the interest cover. Interest cover is the profit before interest, right? Divide by finance cost. Right? Profit before interest, that is operational profit. You know interest cover is profit before interest divided by interest cost. Now profit before interest is the operational profit, that is 440, right? What you have to do, you have to divide 440 by finance cost of 920. Interest cover for current year become 4.39, that is 4.4. If you take into one decimal place, it is 4.4 times, right? How it's calculate? Profit before interest, that is operational profit, divided by finance cost. How many times you can pay your interest? That is the meaning of this, right? Then they ask you to calculate the inventory holding period, right? Inventory holding period, IHP, inventory holding period, right? You know how to calculate inventory holding period. Average inventory. Since you can't take average inventory, you can take inventory divided by cost of sales multiplied by 365, right? Inventory divided by cost of sale multiplied by 365. I will remove this equal sign. This is the formula. Now I can put numbers. Inventory value 2120 according to the numbers. Then let's see how much the inventory, how they given inventory in these questions. Yeah, closing inventory 2120, 2210, right? Cost of sale also given 12,470, right? Very simple, you can calculate 2120 divided by 12,470 multiplied by 365. Number of days 60. How much? 2120 divided by 12,470, right? Multiplied by 365. It's become 12,470. That is correct. 2210. Sorry, here 2210. Typing mistakes. It's become 64, almost 65 days, right? Then debt collection period, same formula I can copy. What I have to change here, debtors divide by credit sales. We have to assume all sales are credit. Debtors divide by sales. We have to assume all sales are credit. Debtors divide by sales into 365. Here, debtors we have 1870 divide by sales. All sales are credit sale 2790 into 365. 33 days, almost 33 days is the answer. Same thing you can go do for the uh, previous year as well, right? That's how you have to calculate this. I think it's clear, right? You don't have question on that. Let's see. Right, nobody questions about that. Okay, now we are moving into the next part. Write a report to the managing director of Superplus PLC highlighting the implications on the following areas: efficiency, liquidity, working capital management, and asset utilization. Now they ask you to write a report. Therefore, you have to put to whom you are writing. Write down to managing director. From you are the finance consultant. Subject: analysis of efficiency, liquidity, working capital, and asset utilization of this company for the year 22-23 and 21-22. Then you have to write down the date. Likewise, you have to start a report, right? Then you can start one by one, write down efficiency. Efficiency is credit settlement date, debtors collection dates, and asset turnover dates, right? Once you take this, you can take cash cycle as well, right? Then you can write down here credit settlement days come down from 35 to 30, right? Likewise, you have to calculate inventory turnover period for the both years. We calculated for 1 year, and debtors collection period also for the both years. Then you have to comment on that. You have to say, for an example, here I can say credit settlement period has reduced from 35 days to 30 days. That means they have accelerated the payment for suppliers, right? Meantime, by how many days inventory turnover period increase or decrease? Or by how many days debtors collection period increase or decrease? Write down those things in sentences, right? Then getting all these three together, you can calculate the working capital cycle. Data collection period plus inventory turnover period minus creditor settlement period. Answer will be cash cycle, right? Then compare 2 years cash cycle, right? Last year cash cycle this much, this year cash cycle this much. When cash cycle increase, you have to borrow more. When cash cycle decrease, you have to borrow less. Those things you have to write down. That's how you have to answer, right? Now we calculated. Now you know there are two years, 22, 3, right? Other one 21, 22. Now take inventory turnover period, then debtors collection period, then minus creditor settlement period. Now this year we calculated inventory turnover period, inventory holding period 65, then data collection period 32. Then we have to take as a minus number 30 days credit settlement period. It is given in the question. Now you can see, right? Total days. Net will be 68 days, right? 68 days means inventory will be converted in 65 days. Debtors will be collected in 33 days, but you have to pay your suppliers in 30 days. That means you have 68 days cashless period. There's a shortage of cash within this 68 days. Why? Once you purchase raw material, say you have purchased raw material today, right? Today, that is day 0. Okay, then that raw material will converted into finished good, and then you have to, it can be taken into inventory, right? Now it will take some time to convert it into inventory. Then you will sell inventory. If you directly buy your finished good, you have to buy it today from supplier and you have to sell it. Then to sell inventory into sales, inventory will goes to sales, take 65 days. Now you bought goods on date 0, but those goods converted into sales in 65 days. Then now here you have a payable balance, right? You have to pay for the supply. Still, it converted into sale, not into cash. Then debtors collection period. The sales will be collected after another 33 days, right? That is, sales goes to cash. Another 33 days. That is 65 plus 33, right? Simply, this material you purchase at the date 0 will be converted into cash in 98 days altogether, right? The item you purchase from supplier on credit has converted into sale after 65 days. Then that sales has been collected after another 33 days. Altogether, goods you purchase on credit has been converted into cash in 98 days. But unfortunately, you have to settle this creditor in 30 days, right? In 30 days, you have to settle. But cash will come after another 68 days. That's why this calls cash cycle, operational cycle. Before 68 days, cash come into the business, cash hit to the business account, you have to settle. Then you have to borrow money. Therefore, company must try to reduce this cash cycle. If it is reducing, it is benefited to the entity because you have lesser period to borrow, right? If it is increased, you have a higher period to borrow. When the period expanding, you have to pay more finance cost. When period shortening, you have to pay less finance cost. I think you got the entire answer, right, on the efficiency. If you have any questions, you can type here, then I can answer. Okay. Then they ask about liquidity. To liquidity, you have to calculate current ratio and quick ratio, right? Just calculate current ratio and quick ratio for the both period and see whether it's come down or increase, right? The increase in me, the current asset divided by current liability, right? If you have more current asset, answer will increase. If you have less current asset, answer will decrease. Or you can take other way. Current liability divided by current asset. If you have a higher answer, it's not a good position. If you have a less answer, it's a good position, right? Then better way, current asset divided by current liability. If you have a bigger answer, means you have more current asset. If you have a lesser answer, means you have less current assets, right? Then you can calculate quick asset ratio also. That is, you can reduce inventory from the current asset and calculate the current ratio again. Calculate it for the both years and comment on that, right? Here you have to calculate and comment on that. Then working capital we already done with the efficiency. Therefore, no need to calculate it again, to do it again, because we have calculated part of the working capital in cash cycle, that working capital cycle, right? Again, you can comment on that if you want. They take the difference between current asset and current liabilities, right? Take the difference between current asset and current liabilities and comment on that. That difference should be higher. Therefore, when you talk about efficiency and liquidity, automatically you will talk about working capital management, right? Then asset utilization, you have to divide sales by total asset. That's the way. Sales by total asset utilization, right? I will calculate it for you because it's new for you, I think. Asset utilization. Sales divided by total assets. You can calculate it for the both years Sales 2790 19500 2790 19500 for the 2 years, right? Now let's see total asset. How much total assets? Fixed asset turnover. They have already calculated fixed asset turnover, operating margin, capital employed, current ratio, closing debtors, quick asset ratio also they calculate. Don't no need to calculate again. Current ratio also calculated. No need to calculate it again. Now, asset utilization, fixed asset turnover they have calculated. That's a good fixed asset turnover. That is sales divided by fixed asset, right? Then you no need to calculate that. You can comment on this, right? Here, fixed asset turnover has come down. Come down means your turnover came down, or your fixed asset has increased. If fixed asset has increased, definitely your sales has to be increased, right? Therefore, fixed asset turnover coming down means you are not operating well. Why? Sales divide by fixed asset. Answer should be higher rate. Because if you have more sales, that is better. If you have lesser sales, that is not better. Now it came down from 2.8 to 2.4. That is, there is a reduction of efficiency, sales, operations. There's a reduction. That is not a good sign for the company. Sales came down. Or fixed asset has increased faster than increasing of sales. But generally, when you invest in fixed asset, your sales has to be increased. But as expected, company has not increased their sales. There is an inefficiency. Further, industry average is 3 times, but company has recorded only 2.4. Against the industry also, company shows a weakened position, and comparing to the last year, also company shows a weakened position. If you go through the P&L carefully, you can see sales has increased from 19,500 to 20,790. But fixed asset turnover decrease means your fixed asset has increased comparing to the in a higher rate comparing to the sales. That means the investment you made on fixed asset has not generated enough sales. And this ratio also well below the company rates as well, the industry average also. Therefore, company is not in a good position in the point of fixed asset turnover. That is best solution for the asset utilization, right? The write-up will be shared with CA Sri Lanka. I will ask them to share because I don't want to read in front of you this. I want to explain how to take it, right? If you have any question, please put it in the chat. Now, after ethics question, no question, no any such things asked here, right? Okay, then we can move into the consolidation question. Now, 8:18. Can we have 15 minutes break? I think it's better. We have to do another 2 questions. I think we have to make this question with you one by one. I have to make the calculations. Therefore, can we have 15-minute breaks? Can I tell you exactly the time we are going to start? Let's start at 8. Now 8:20. Let's start at 8:40. Is that okay? 20 minutes break. Can you say okay if you are okay with this? Okay. Please join with me 8:20 exactly, right? Thank you. 8:20 we will start again. Okay, let's start question number 6 7. Please text me. You can see you can you hear me now? Can you text me whether you can hear me, and can you see my screen as well?
We can't see the screen, but we can hear you. We can hear you, but we can't see the screen.
Right. Now I have shared it. What about now? I think you must see now my screen. Okay.
Yes, now
Right.
we can
Okay,
see.
let's go to the question number 6. Thank you. Let's go to the question number 6. Because of the complexity of the question, first I will read the question, then I will directly go to the answer. I think you also have your question with you. Let's read the questions. There are 3 companies as at 31st March 2023. Unimo, Manukan, Chevron. Plant and equipment investment, they have in all the 3 companies, they have investments. Then current assets, equity, and current liabilities, non-current liabilities, everything is given. This is balance sheet given for 31st March 2023. That's a very important date. Keep it to your mind. Right. Then 1st April 2022 is the opening of the financial year. Also important. Unimo acquired 80 million shares of Manuka Limited by the way of share exchange of 3 Unimo shares for 4 Manuka shares and has obtained control. Right. Now, Manuka is a subsidiary of Unimo. Unimo is the first column given. Right. Unimo acquired Manuka. Unimo issues their own 3 shares for each 4 shares of Manuka, right? The market value of Unimo shares 40, Manuka shares 20. At the beginning of the financial year, this transaction has taken place. Unimo has agreed to make an additional cash payment of 40,262,000 for the former shareholders of Manuka in 5 years' time if Manuka Limited achieves a profit target. That is a contingent consideration agreed in cash. The market interest rate for the similar instrument is 10% and probability of achieving this target is 80%. You need to consider the 80% probability for this contingent consideration. Then you have to discount it by 10% for 5 years to get the present value of this contingent consideration. Then Unimo accounting policy is to measure the non-controlling interest at fair value. You acquired Manuka share price is 20. You acquired 80 million shares. The balance shares has to be multiplied by 20 to get the NCI value, since it is using fair value model. Investment in Manuka Limited has not been recorded in the Unimo, no recorded yet. 1st April 2022, at the beginning of the financial year, Manuka has 12 million shares in issue and showed following reserves balances. Retained earning 40 million at the date of acquisition. Other component equity reserve is 5 million at the date of acquisition. Total 12 million shares, they acquired 8 million. Balance 4 million is the non-controlling interest shares. Fair value exercise was carried out by directors of Unimo PLC to measure the identifiable asset and liabilities of Manuka Limited 1st April 2022, the following were noted. For the purpose of acquisition, Manuka's assets and liabilities as revalued. Right? Let's see what happened. Property that had a carrying value of 150 was valued at fair value of 170 by 20 million. It has increased. The useful life of the depreciable amount is 10 years as at 1st April 2022. It's remained unchanged. Internally generated intangible asset 12 million 1st April 2022, that is a date of acquisition, has not been recognized in the Manuka books. Yes, Manuka can't do it. But for the purpose of acquisition, parent can record it. It was estimated that the intangible asset has a useful life of 6 years. The property and intangible asset are subject to income tax of 15%. That is the purpose of. There are no other deferred tax implication, means you have to calculate deferred tax on this revaluation. Then Unimo has invested 50 million rupees in Chevron Limited. That is the third column given in the balance sheet at the same date, at the beginning of the year, and has acquired 2,000 shares of Chevron Limited. Had 10,000 shares in issue at the date. Now they have 10,000 shares, they acquired 2,000 shares. That is only 20% they acquired. Now you have to see whether they have control. Generally, having 2,000 out of 10,000, you can't take control. Therefore, it can't be a subsidiary. Let's see. Chevron Limited Board of Directors, 7 members. Unimo has the right to appoint only 2 members. Unimo PLC has classified this investment as fair value through other comprehensive income. It is separate financial statement. Now, you can see they don't have control. Only 20% shares. But they can appoint 2 members out of 7. That means they can make significant influence over the business. They can't control because they don't have majority members in the board, but they can make a significant influence over the board. Therefore, this investment should be recognized as an investment in associate. Right? They have to follow the equity method of accounting to account for this investment in associate. But incorrectly, they have recorded this one, sorry, not incorrectly, in separate financials, they have recognized it as fair value through other comprehensive income. But this should be recognized as an investment in associate. That's the requirement. The fair value of the investment in Chevron Limited 31st March 2023, 55 million, and this was recorded in Unimo separate financial statement. They have recorded it as fair value through OCI, therefore they recorded this at fair value, but it has to be an associate. At the date of acquisition, Chevron Limited shows the following reserve balances in their separate financial statement. There was no material difference in the carrying value of the net asset of Chevron Limited and fair value of those net asset at the date of investment. Retained earning 50 million, other component equity 15 million at the date of acquisition of this associate. During the financial year, Manuka Limited has sold 2 million units of production to Unimo. Right? That is subsidiary sold goods to the parent. And Unimo PLC turn has sold 50% of units to final customer and balance still at the Unimo inventory. Intercompany sales, intercompany cost of sales you have to eliminate. Then 50% of the sales remain with the buyer, that is parent. There is a unrealized profit. You have to remove this unrealized profit as well. Manuka Limited sales unit at 20 million to Unimo and cost of unit to Manuka is 12. That you can see there is an unrealized profit. Manuka Limited sold an equipment item to Unimo Limited at a value of 50 million within the financial year. The carrying value of the machine is 40 million, remaining life is 5 years. Now, there is another intercompany transaction, fixed assets sold from subsidiary to the parent, right? There is a profit also. Now you need to eliminate this profit. And there is a over depreciation because when subsidiary add a profit margin and sell it to the parent will depreciate the asset at the purchase price. Purchase price include intercompany profit. That profit has to be eliminated. Over depreciation also has to be eliminated. The last, as at reporting date, Manuka Limited has a receivable balance from Unimo PLC and Chevron Limited amounting 20 million and 10 million respectively. Chevron Limited financial statement showed the same amount as payable balance. However, Unimo PLC showed a payable balance of 50 million. Reason for this difference was cash in transit and good in transit. That is intercompany balance reconciliation also you need to do. Now examiner asks us to do prepare consolidated statement of financial position, right? Directly I will take the answer and show it to you how to do that, right? Because the students in the classroom now have different methods of calculating goodwill. Some people use column basis and just calculate the goodwill as a statement. Some people do the double entries to do that, right? Okay, let's start doing this one. First of all, you have to calculate, you have to rule the consolidated balance sheet, right? You have to put all the assets and liabilities of Unimo and Manuka together, but don't take Chevron because Chevron is an associate, right? Okay, let's start with the calculation of goodwill. I think I can share the answer here. Right. The first point mentioned, right? First point in the question mentioned, uh, there is a share exchange to acquire the business. Parent issue 3 shares for each 4 shares of Manuka. Share price also there. They acquired 8 million shares. Therefore, 8 million has to be divided by 4 and multiplied by 3 to get the number of shares to be issued by Unimo, right? Because Unimo agreed to issue 3 shares for each 4 of subsidiary. Now they acquired 8 million, then divide by 4, then 2000 multiplied by 3, 6,000. Now they have to, better I will calculate it, right? I think it is better you can easily understand. Otherwise you will be confused with the calculation, right? Okay, let's go to the calculation sheet. Let's take a new sheet. Right, purchase consideration. Share exchange. Right, they acquired 8 million shares. Let's prepare it in rupee thousand, right? 8 million shares. They issue 3 shares for each 4. 3 for each 4. That means you have to divide this by 4, right? Then you have to multiply this by 3 to get the number of shares to be issued by parent, right? Multiplied by 3. Then you can see number of shares to be issued by parent, right? Then value of shares. Parent has to issue his own shares, that is 6,000 shares has to issue at price of 40 rupees. Therefore, 240,000 is the purchase consideration in share exchange, right? Then there is another purchase consideration, that is contingent consideration, right? They will pay in 5 years, right? The value they are going to pay 40,263. We prepare in thousands, therefore I will take numbers in 1,263. This is the value to be paid in 5 years, right? In 5 years you have to pay this amount. Discount rate is 10%. Since this is a contingent consideration, you have to take the probability of achieving this. Probability of achieving this is 80%, they have mentioned, right? And the discount factor they have mentioned as 10%, right? Now let's calculate the contingent consideration. Very simple. Let's take this amount into 80% first. This is the amount to be paid based on the probability. Then let's discounting factor. You know it is 5 years. 1 divided by 1.1, right, power 5. The discounting factor will be 0.620, right? Then we can take the present value of the consideration, this into the discounting factor value would be 20,000. We can correctly take 20,000, right? That is 20,000. Now these are the two purchase considerations you need to consider, right, in the calculation of goodwill. Right, this is how you have to calculate the purchase consideration. Then they have mentioned uh, non-controlling interest will be calculated at fair value. Now we need to calculate non-controlling interest, NCI, right? Let's calculate NCI now. They have 12,000 shares. Out of that, they acquired 8,000 shares. Therefore, NCI has 4,000 shares, right? Share price of Manuka is 20, right? Market price per share. Therefore, NCI at fair value will be 4,000 into 20. It would be 80,000, right? NCI value would be 80,000. I think it should be 80,000 because number of shares total would be total number of shares of the Manuka, the subsidiary given in question. I am going to the, sorry, not 12,000. Yeah, in 1,000, 12,000 they have, right? We are making it in 1,000. 12 million shares Manuka has. Since we are preparing in 1,000, we have to take 12,000, right? Then in 1,000 it is 80, right? Share price is 20. Okay. Then after NCI calculation, 1st April, the date of acquisition, they have retained earning 40 million, other component equity 5 million. Then fair value adjustment. Now let's calculate the goodwill, NCI, consolidated retained earning, everything I will work on here, right? Okay. I will generally use the T account formats, right? Because in your answer also, examiner recommended to go through the double entries. Therefore, I will use the T account format to do these calculations, right? You have to calculate goodwill, then you have to calculate NCI, right? Then you have to calculate consolidated retained earning, right? Here I will say this goodwill account, or traditionally we can say cost of control account, whatever is correct, right? Then NCI account, then you have to calculate consolidated retained earnings as well. Okay. Now, according to the parents' information in the balance sheet, I think better to take this into the next sheet. Then you can easily see these numbers, right? Right. Okay. Now, as you know, you have to take parents' detail here, retained earnings, balance of parent. I will write down Unimo's balance, right? Unimo's balance of retained earning is 70,000, right? Let's take other component of equity also, because they have another reserve account, that is other component of equity. Other component of equity. Also, Unimo has a balance that is 20,000. Parent balances you have to take here. Okay, now let's calculate purchase consideration. Purchase consideration, right? The total purchase consideration would be in shares and contingent liabilities. Shares and contingent liabilities. Consideration is a liability, right? Contingent consideration is a liability. Right. You know how much we calculate in shares? 240,000. In contingent consideration, we calculate it as 20,000. Right. Now, these two numbers should have a double entry. Goodwill account debit, share capital account credit. Right. Therefore, this should be credited to share capital account at 240,000. If you look here, right, this is the consolidated balance sheet prepared. Yes. If you go to the share capital, stated capital here, right? Stated capital, 150,000 already they have, right? Parent company already have 150,000 stated capital. It has to be increased further by 240,000. That is the double entry I showed you here, right? Goodwill account debit, share capital account credit, because parent issued shares. I think it's clear. If you have any issue, please tell me, right? Please text me here in the note. Why we need to multiply 8,000? Already they have given acquired number of shares. Because they acquired these 8,000 shares after issuing their own shares. How they issue their own shares? They issued their 3 shares for each 4 shares of the subsidiary. Right? They issued, parent issued 3 shares to acquire 4 shares of the parent subsidiary. Now, they totally acquired 8,000 shares of the subsidiary. For that, they issue 3 shares for each 4. Therefore, 8,000 has to be divided by 4 and multiplied by 3. Then answer will be 6,000. Then parent has to issue 6,000 shares from his own share capital at 40 rupees per share. Not, is that 40? Yes. 40 rupees per share. Right? That's why we have multiplied and took that value. The purchase consideration in share issue, 240,000. Right? Then contingent consideration, we have calculated it as 20,000. Again, you have to follow the double entry, goodwill account debit. You have to record this in non-current liability because this has to pay it in 5 years. If you go to the answer here, right, in my balance sheet, look at non-current liabilities, contingent consideration, credited 20,000 here, right? Then there is an additional adjustment. You credited 20,000 non-current liabilities as contingent consideration and debit goodwill account. This is at the beginning of the year, at the date of acquisition. Now you already completed 1 year. For that 1 year period, you need to recognize finance cost on that. It's a liability. Then you have to recognize finance cost. You discounted by 10%, therefore you have to multiply it by 10% to get the interest for 1 year. If you multiply it by this by 10%, interest for 1 year will be 2,000. This is after acquisition. You need to recognize finance cost. Therefore, this should be debited into the consolidated retained earning as an expense. Finance cost. This has to be paid by parent 2,000, and this should be added to the liability as liability increase. That's why you can see here 2,000 added to the contingent consideration. Finally, it became 22,000. Now this line completed. Right? Got it? You first record the contingent consideration, then you will recognize interest for 1 year because you already completed 1 year from the acquisition date. Right? Now you have to take the NCI. NCI double entry will be goodwill account debit, NCI account credit. The goodwill or cost of control. Now we already calculated NCI value here. 4,000 shares or 4 million shares in 1,000 rupees 20 per share of the subsidiary as per the given information. Manuka shares rupees 20, therefore value will be 8,000. Right? That double entry you have to pass here, debit 80,000 and NCI account credit the same 80,000 as NCI value. Right? Now you can see entire value of the business that we paid, that the parent paid, and NCI is here in the debit side. Now you have to bring their whole share capital, retained earning, and other component equity as at the date of acquisition into the credit side of the goodwill, and whatever the revaluation you made, then you can get the goodwill. Right? Okay. Now in the question they clearly mention, for the purpose of acquisition, the property has valued from 150 million to 170 million. Right? That is, property value increased by 20,000. In 1,000 to 20,000, it is increased. Right? Now, at the date of acquisition, first of all, let's take their net asset before making any adjustment. What are the net assets? Share capital of subsidiary, retained earnings of subsidiary, other component of equity of subsidiary at the date of acquisition. As per the information, there is no share issue after the acquisition. Therefore, share capital of the subsidiary was 120,000. As per the information 1, right? As per the information 1, at the date of acquisition, the retained earning was in 1,000, 40,000. In 1,000, 40,000. And other component equity was 5,000 in 1,000. Right? Now you can do the other entries. But before do that, keep it your mind these two numbers, that retained earning and OCI, other component of equity. Because in the given balance sheet, today at the reporting date, retained earning was 50,000. Today, other component equity was 10,000. Right? That means retained earning earn more 10,000 after acquisition and 5,000 for other component equity. That means this part was earned after acquisition, post acquisition. Post acquisition amount, this is the amount recorded in the balance sheet, this is the amount at the reporting date. Therefore, amount additionally earned is post acquisition. Post acquisition items will be transferred to the parent's reserves and the NCI. Therefore, this 10,000, right, out of this 10,000, two-thirds, because 12,000 is the total shares, 8,000 acquired by parent, 4,000 for subsidiary. If you take the ratios here, two-thirds, right? Here, one-third for NCI. This is for parent. That was consolidated retained earnings. Let's say parent. Here NCI. Right? Now 10,000 multiplied by this for parent, 10,000 multiplied by this for NCI. Right? Again for 5,000 also post acquisition, 5,000 multiplied by this for parent. Right? 5,000 multiplied by this for NCI. Right? These value you have to record it in consolidated retained earning, consolidated other component equity, and NCI. That's how you have to record it. Right? Now here you have consolidated retained earning from subsidiary, that is Manuka. You have retained earning of this much after acquisition. Right? Let's take all into non-decimal numbers, right? This part. This amount belong into the NCI, retains earnings after acquisition. This much, right? Then consolidated other component equity from Manuka after acquisition. They have this much, and NCI have other component equity, the balance entitled to him, right? Right. What I wanted to tell you this part, this is not relating to the ledger accounts, but the calculation post acquisition numbers, right? This is post acquisition retained earnings, the difference between the today balance and the date of acquisition, that is 10,000 and 5,000. We allocated them on parent and NCI since it is post acquisition, right? Now you can record. I'm checking your answer also to see whether there is any adjustment required, because we have to correct it before share this document with you. Sometimes there may be some typing mistakes, right? Now you can go to the application of revaluation. Property worth 150 million, valued to 170. Right? Now what we have to do? You have to increase your property by 20,000. Then you have to go to your balance sheet, go to the property, non-current assets, property. Here, this is the properties. Now you already have property from Unimo 250,000, Manuka 200,000. That has to be taken here. They just mentioned here you have to take Manuka property and Unimo property here. Then you have to plus that revaluation 20,000. That is this. That revaluation 20,000. Property credit, keep it in your mind. Sorry, property debit, you have to add to the property because property value increase. Property debit, goodwill account credit, say property. That is the double entry for 20,000 revaluation, right? Then they mention the depreciable amount the useful life of the depreciable amount is 10 years. Now they increase their property by 20,000. Therefore, now they have to depreciate it for 1 year. Why? Acquired before 1 year. Now already completed 1 year. Since you have increased property by 20,000, you need to depreciate it also for that 20,000, because subsidiary individually in his separate financials, he hasn't depreciated that additional amount 20,000. 10 years means depreciation is, you have to calculate depreciation for this additional amount, that is 20,000 divided by 10. That means your depreciation per annum will be 2,000, right? That 2,000 you have to record it as a after acquisition entry, P&L debit, right? Subsidiary P&L debit, because this asset belonging to subsidiary, subsidiary P&L debit, asset credit. If you go to the asset line, you can see here they credited to the asset 2,000, right? They credited this 2,000 to the asset credit depreciation. Then it is after acquisition, therefore this has to be debited to the subsidiary profit. But you already transferred subsidiary profit here and here. Look here. These are the two subsidiary profit after acquisition. You allocated among NCI and consolidated retained earning. Therefore, now you have to debit this depreciation 2,000 to both of them according to the ratio. Therefore, I can debit NCI depreciation and this guy consolidated retained earning also depreciation. For NCI, it should be 1/3 for out of the 2,000, right? For this guy, it is 2/3 out of the 2,000. Instead of debiting into subsidiary P&L, because it already transferred here, you can debit into these two parties. Therefore, 2,000 multiplied by 1/3, right? Here, 2,000 multiplied by 2/3. Right? In your answer script, each item you have double entries, don't worry. Right? The double entry is NCI debit his portion of depreciation, consolidated retained earning debit the parent portion of depreciation, total 2,000 credit to property account, because it has to be depreciated. Then there is another evaluation, that is they recognize intangible asset. This subsidiary in his books he can't recognize, but for the purpose of acquisition, parent can recognize this 12 million intangible asset. Now you have to record intangible asset debit, here credit. Intangible asset debit, here credit. The value is 12,000. Now you can go to the account and see here intangible asset, they added 12,000. Intangible asset debit, goodwill account credit. Right? Now this also will be amortized over 6 years. Right? Amortization 6 years. How? 12,000 divided by 6, right? That is 12,000 divided by 6, 2,000 again. Same thing you have to do. You have to reduce it from the asset credit amortization here, asset credit amortization 2,000, and subsidiary profit has to be debited. Now subsidiary profit has been distributed already among parent and NCI. Therefore, you have to debit into their accounts like we debited depreciation. Here I can say amortization 1/3 of 2,000. Right? Here also amortization 2/3 of 2,000. same value, right? I can take here for the easy of computation because both are 2000, right here, right? Then they mention property and intangible asset are subject to tax of 15%. Now you can see property has increased by 20,000 by a revaluation, intangible asset increased by 12,000 for the purpose of acquisition by 12,000. Now altogether it has increased by 32,000 total asset. That is carrying value increased by 32,000 altogether. Carrying value increased by 32,000. But even though they acquired another company, they revalued for the purpose of acquisition, tax base won't change. Tax base remain unchanged. Then whatever the value increase, you have to have additional taxable temporary difference. For this 32,000, you need to recognize deferred tax impact. The tax rate is 15%. Therefore, you have to increase your deferred tax liability by 15% on this 32,000. Deferred tax account credit, goodwill account debit. Deferred tax. How? 32,000 into 15%. Right? 32,000 multiplied by 15%. Let's see. 32,000 multiplied by 15%. This should be the deferred tax. Now, this account debit deferred tax account, right? Deferred tax account should be credited 4,800. That means 15,000 on 20,000 plus 15,000 on 12,000, right? If you take it separately, I will show it to you. If you take it separately, 15,000 on this, separately it will be this into 15%. 3,000 and 1,800 you have to debit into the total 4,800 here and credit into deferred tax account. If you go to the balance sheet of the answer, that's come under non-current liability, right? Deferred tax come under non-current liability here. You can see from the property 3,000 deferred tax, and here you have 1,800 the deferred tax impact, right? This calculation also available in the working also. It's referred to working 8, working 12, right? We will share this after the discussion. Now you can see we already recognize 3,000 and 1,800. Now the problem is this deferred tax we recognize at the beginning of the year, but thereafter we depreciated the property by 2,000 and we amortize the intangible asset by 2,000, right? Since we depreciated and amortized, its carrying value came down, right? Its carrying value came down. If you take here, right, 2,000 is the value, but we depreciated the 20,000 is the value, but we depreciated 2,000 per annum. Therefore, carrying value will be 18,000, right? Now, this is intangible asset 12,000, but we amortized 2,000. Now, carrying value is 10,000. Now, current carrying value at the reporting date, if you calculate deferred tax, this is the value should be, right? But we recognize 3,000 and 1,800 at the acquisition date. Here we recognize 3,000. Here we recognize 1,800 at the reporting date. That is 1st April 2022 at the date of acquisition. Now we are at 31st March 2023. right? Now you can see, since 1 year completed, the deferred tax liability has to be reduced because time completed by 1 year. Therefore, you have to debit again 300 into the deferred tax account for property and 300 to the deferred tax account because of intangible asset. Altogether, 600 you have to debit into the intangible asset, sorry, deferred tax account, right? And you have to take it back to the profit you already provided. Now it is coming back. That is deferred tax behavior, right? But this deferred tax impact to the subsidiary. Therefore, this reduction of liability after 1 year has to be credited into the subsidiary's profit. But keep in your mind, subsidiary profit already allocated among parent and NCI. Now what we are going to do, you have to debit this 600 to the deferred tax account. Here you can see they debited 300 separately to the deferred tax account, right? Because 1 year completed, therefore reduction of the carrying value, deferred tax liability also will reduce. 600 you have to debit into the deferred tax account for the two assets. You debit it to the deferred tax account, then you have to credit into the profit of subsidiary. But it already allocated among parent and NCI. Therefore, you can credit into the both account to according to their percentage. Deferred tax total 600. Out of that, one third. Deferred tax total value 600. Out of that, two third. Right? 600 multiplied by one third. 600 multiplied by two third. That is 400. That's how you have to credit into the profit of subsidiary. Subsidiary profit is here and here. Therefore, whatever the adjustment you have to make to that subsidiary profit will make in NCI account and consolidated retained earning account. Right? Now we have made the deferred tax adjustments also. Now all the transaction for the acquisition we already made. Now you can see if there is a goodwill or gain from bargain in purchase in goodwill account, right? Here the total is 344 400. Here total is 197. Yes, this side is higher. We can take the total, right? We can take this into the other side, and the difference is minus all the numbers you recorded here. There's a value of 440,800. This will be the goodwill, right? At the date of acquisition, right? Let's see. Let's remove the decimal places for the ease of understanding, right? Then 147,800 would be the goodwill. Let's see in the goodwill calculation in the answer. Goodwill. You can see here 147,800 is the goodwill. Answer is correct, right? 147,800 is the goodwill, right? Right. This is the goodwill. Let's see any question is there. Why not got the annuity factor? Because you have to make a payment in 5 years, not every year. If you make a payment in every year, you will get the annuity factor. But this is only one-time payment after 5th year. Can we get the recording, sir? Yes, they will share. If question did not state the investment has not been recorded, is it need to add newly issued shares? No. If investment has been recorded, you no need to add it. It has to be in the balance sheet. Then it has to be in the balance sheet, right? That's the point. But in share issue case, they will mention definitely it has not been recorded. So can we take round figure like 67%? Yes, yes. In manual calculation, take it as 67. That's the easiest way, because when you do it manually, like I'm doing in decimal correctly, because I have Excel, but you don't have Excel in the exam, therefore you can use 67% and 33. How get the percentage? That is 67 and 33 is the best for manual calculation. So must we use T account in the answer paper also? It is not compulsory, but my personal view, you must learn double entries in consolidation exactly. Otherwise, you won't be able to work in a group company as a finance controller. Because now now I am working as a CFO of a company, group company. Most of the people can't prepare consolidated accounts at least 70% correct. Most of the companies, finance controllers can't prepare their consolidation correctly. Why? They just calculated at the classroom in statement basis. Then they can't understand a very huge complex transaction, right? Without having double entry knowledge, you can't do practical consolidation. That's my view. Therefore, my advice is to go with T accounts, but in the exam, they will accept whatever the method you calculated. Don't worry. Like in this answer script, you can calculate on a row on the face of balance sheet. That will accept. Can't we divide return earning of subsidiary after do all the adjustment? Yes, you can do. No issue. So depreciation adjustment of DT is it should be done, sir. Yes. Is it mandated to adjust the deferred tax changes as of the reporting date? Yeah. If tax rate is there, you have to make the adjustment, right? Okay, moving back to the question again. Now, adjustment number 1 is okay. Adjustment number 2, Unimo PLC has invested 50 million in Chevron, that is 2000 shares out of 10,000. But they can appoint 2 directors out of 7. That means they have significant influence. This should be classified as an investment in associate, but they have incorrectly recognized as an investment in fair value through OCI. Now you have to prepare another ledger accounts, that is investment in associate account, right? I will just copy accounts here in a new sheet. Investment in associate, right? Right. How much they have invested? 50 million rupees. If you go back to their balance sheet, you can see there is a 90 million value. I think because of that fair value increase at the end of the reporting date. At the end of the reporting date, the fair value 55 million and it was recorded in universal financial statements. Right. Now, the cost of the investment should be recorded first, right? But now it is 55 million at the reporting date because of the fair value, right? Now that means within the balance sheet, now it's worth 55 million. Therefore, let's take that balance. Balance at fair value 55,000, because they have revalued, fair valued it at 55 million at the reporting date. Now, first of all, you have to remove this fair value. How you can remove? Credit here, debit PNL, right? Manuka PNL has to be debited, not PNL, OCI. Other component equity, fair value through OCI. Manuka OCI has to be debited 5,000 to remove this, right? Now this debit, now if you go to the PNL, the OCI already allocated among right? Consolidated other component equity and NCI. These are the two numbers we allocated, right? Other component equity goes to NCI and other component equity goes to parent. Now you have to debit into these two accounts. That's the theory, right? You have to debit into this account. How much you have to debit? 5,000. That means exactly these two numbers you have to debit it, right? You can debit here investment in associate. How much? 1/3 from 5,000. Same value. Here also investment in associate 1/3 from 2/3 from 5,000. You have to remove. Now it is at cost. Very simple. Now all these numbers are cost, right? Now you can do necessary adjustment. Before do that, cost of investment was 50,000 in thousand. At the date of acquisition, they had share capital, they had retained earnings, like they have mentioned. Other component equity also they had at the date of acquisition, this associate. Other component of equity also they had. Share capital won't change from the date of acquisition of associate. Share capital was 100,000. Sorry, 100,000. Retained earning was 50,000 at the date of associate acquisition. And other component equity was 15,000, right? Now this is the total. If you take, this is the total of the associate net asset at the date of acquisition. We acquired 2,000 shares out of 8,000 shares. Out of 8,000 shares. That is, we acquired 25%. I think I'm correct with the numbers. 2,000 shares out of 10,000. Sorry. 2,000 shares out of 10,000 we acquired. That is, we acquired 20%. Right? Now, at the date of acquisition, we acquired 20% of the net asset. Right? That means we acquired 33,000 of net asset after paying 50,000. That means you paid more to acquire 20%. The amount additionally you paid will be the goodwill on acquisition of associate. There is a goodwill on acquisition of associate. As per the LKS 28, investment in associate clearly mentioned, if there is a goodwill on acquisition, don't separate, allow it to be in the same investment in associate. Therefore, you don't want to separate goodwill from the investment. But if there is a gain from bargaining purchase, you have to record it in the P&L as a gain. But if there is a goodwill, no need to separate. You can keep it here. Right? Therefore, you can keep the investment as 50,000. Right. Now, the second interesting story is at the reporting date, balance sheet given date, they have share capital 100,000, no change, but they have retained earning 70,000. They have retained earning 70,000. They have other component of equity 10,000, no change. There is a change, 10,000. Right? Now you can see this is reporting date. This is acquisition date. This is 1st April 2022. But this is 31st March 2023. Now you can see there is an increase. How much the increase? Here 20,000 increase. There is a decrease. How much the decrease? 5,000 decrease. Right? Now this increase or decrease share of profit from investment in associate, I think you can remember. After acquisition, you must recognize only the share. Now you can see, right? They have a profit share of entire profit of 20,000. Out of that, we need to take 20%. Then other component of equity also, we need to take 20%. Right? This is the parent share. Parent share. That is 20%. Right? This has to be recognized. Now what we can do, I think you have to give me 5 minutes. My battery is going to off. I will quickly bring my charger. Right? I will quickly bring my charger. Please give me 5 minutes. I have to pick up my from downstairs. I will quickly bring it. Give me 5 minutes. Right? Can you hear me, all of you? Just please say yes if you can hear me and see the screen. Right? Yeah.
Yes,
Okay.
we can hear. We can hear.
Right. Now here, parents portion of the profit 4,000. It has to be debit into the investment, right? Debit, and it has to be credit into consolidated retained earnings, right? Therefore, we will go back to consolidated retained earning and mention associate profit 4,000, right? Then again, you can see other component equity, there is a minus 1,000. Minus 1,000 means that other component equity has to be debit, this account has to be credit, OCE, right? From associate. Minus 1,000 is here, credit, this other component equity has to be debit, right? Associate, from associate. That's how you have to adjust this investment in associate account, right? Then you can see the balance. Okay, that is the end of adjustment number 2. Now we are moving into adjustment number 3, intercompany transactions. Okay, let's see. Adjustment number 3 mentioned during the financial year, subsidiary sold 2 million worth goods, 2 million units of production to Unimo parent, and parent sold only 50% of this. They sold it at 20 rupees per unit, but cost is 12. Okay. Now let's see. Intercompany sales, right? Subsidiary sold to parent, right? How many units? Subsidiary sales, right? Parent purchase. Therefore, in parents, it's available in cost of sale. Subsidiary, it's available in sales. 2 million means 2000. They sold it at how much? 20 rupees. Right? Subsidiary sales include 4,000, 40,000, and these parents cost of sale include 40,000. But we are not preparing P&L, therefore we no need to eliminate sales and cost of sale. Out of this 40,000, they sold 50,000. Therefore, another 50,000 remains in inventory. This is remains in inventory of parents inventory. But this cost is 12. Therefore, there is a 8 rupee unrealized profit because cost is 12, selling price is 20, therefore profit is 8. As a profit on sales price, it is 40%. If you calculate unrealized profit on sales price, it is 40%. You can see here. Unrealized profit on sales, 40%. Therefore, out of this, 40% is unrealized profit, 8,000. This has to be eliminated from the inventory as well as subsidiaries profit. This profit is available in the subsidiary. Subsidiary profit has increased by 8,000. Profit. Parents inventory increased by 8,000. If you go to the balance sheet and see inventory, here you can see they have eliminated 8,000 as unrealized profit from the parents inventory. Then you need to eliminate this from subsidiaries profit. But subsidiary profit already allocated among NCI and parent. Now what you need to do, debit into these two accounts according to the ratio, unrealized profit, right? 8,000 multiplied by 1/3, right? Same thing, 8,000 multiplied by 2/3, right? That's the double entry. NCI debit, consolidated retained earning debit, inventory credit, right? Then we are moving into the point number 4. Again, subsidiary sold an equipment to parent. Value is 50, but its carrying value was 40. That means subsidiary make a profit of 10 million, right? Subsidiary make a profit of 10 million. Now what you need to do? You have to remove this 10 million from the subsidiary P&L. Again, you know, subsidiary P&L is here and here. Then you can debit here. You have to remove this 10 million from property because parent purchased this at 50,000 and recorded as cost. Therefore, property has to be reduced by 10,000. Profit has to be reduced by 10,000. Profit is subsidiary's profit. Therefore, property, you can debit here 10,000 into 1/3. Here, property 10,000 into 2/3, right? Now this debit, 10,000 debit into the profit has to be credited into property. Here you can see property credited 10,000, right? Intercompany profit made during the asset trans. Now, below what will happen then? Right? This property sold on 1st October 2022, right? That means mid of the year, exactly 6 months before the end of the year. Parent purchased at 50,000 and depreciated on 50,000, but it has to be depreciated within the group on 40,000. That means they have depreciated over on 10,000. Therefore, you have to remove depreciation made on profit from the person who depreciated the asset, right? Who depreciated the asset? Purchaser. Who is the purchaser? Parent. Parent recognize additional depreciation. If I calculate it here and show it to you, right? Parent purchase this asset on 50,000, but group value is 40,000. Over recognized 10,000 profit we have eliminated, but purchaser individually depreciated this. This has useful life of 5 years, but this was purchased mid of the year, therefore they depreciated over half of this, that is 100,000. 1,000 depreciated over depreciation by parent. Therefore, you have to debit into the parent's profit and loss 1,000, and you have to credit into the debit into the asset. Sorry, I have changed that side. Over depreciation, therefore this should be in credit side. Remove depreciation, you have to remove the depreciation, therefore you have to credit into the parent P&L and debit into the this account, right? But here it has not mentioned. You can check with the this 20,000 2,000 is correct. This working not recognize that 1,000, right? Manuka has sold an equipment to Unimo value. The carrying value is that date for, and its remaining useful life of 5 years. That means you have to record here, right? Make it down. When you get the answer, you have to make it that adjustment here, right? You have to add back 1,000 here, right? You have to add back 1,000 here. Working number 9 not recognize that 1,000. They have recognized only 2,000 for the revaluation of property. Yeah, you have to add back another 1,000 here. Keep it your mind. Is that okay? Audience, can you tell me yes or not? Did you get it? Please tell me if yes or not. Okay, good. Now we are moving into the adjustment number 5. Manuka had made sales worth 20 million to several limited during the year, keeping a profit of 20%. That Manuka is the subsidiary, Chevron is the associate, right? Manuka sold goods to associate, keeping 20% margin. on sales price, that is 4 on 20. 80% of those sales remain in Chevron inventory. Okay, now let's go to that. Another calculation in Excel. Unimo is the parent, then Manuka and Chevron. This is associate, this is subsidiary, this is parent, right? Now Manuka sold goods to Chevron, right? How much? 20. 20 worth goods sold. Out of that, Chevron inventory consists 80% of this. 80% of this is consist here. Now 20% margin. That means 20% on this, right? 20% on this is unrealized profit. How much? Now Chevron inventory overvalue by 3.2, Manuka profit overvalue by 3.2. Manuka's profit overvalue by 3.2, same value. Now what would be the entry we have to make, right? If you go to the account, yeah, investment in associate, right? They have adjusted it. I want to check whether they have actually adjusted. Otherwise, I can tell you, you make to adjust it. Right now, 3.2. This is million. We are working in thousand. Therefore, let's put thousand, right? Sorry, we are putting in thousand. They gave numbers right. 3,200. Sorry, 3,200 in thousand. Now we have to remove this. But keep in your mind, Manuka sold to Chevron, right? Chevron is an associate. We own only 20%. Therefore, no need to make adjustment to the entire. We have to make adjustment only for 20% of this because our stake on associate is 20%. Therefore, we will make adjustment only for 20%. Right? Now, what we can do? This 20% has to be removed. This has to be removed from investment in associate account because we don't have associate inventory in our balance sheet, isn't it? Because we are not line by line console associate assets and liability. We only take the investment. Therefore, we don't have Chevron inventory in our books. Therefore, we can reduce only from the investment in associate. You have to go to the investment in associate and credit unrealized profit, right? That is 640, right? This profit has been earned. Keep in your mind, this profit has been earned by subsidiary. Therefore, you have to remove it from subsidiary profit. Subsidiary profit means that is with NCI and parent both, right? NCI and parent both. Therefore, you have to remove unrealized profit from these two parties, right? Debit NCI 213, debit consolidated retained earnings 427, credit investment in associate 640. That is the entry for the adjustment of sales between subsidiary and associate. Then last one, as the reporting date, Manuka had a receivable balance. Right, let's do that working quickly. Right, Manuka has receivable balance from Unimo. Right, Unimo has a payable balance. Manuka should have a receivable balance. That's correct. Okay, Manuka has a receivable balance from Unimo and Chevron Limited. Manuka has, Chevron also has a payable balance. Manuka has a receivable balance from Chevron, right? Okay, let's put numbers together. Okay, Manuka has a receivable balance from Unimo 20,000, right? From Chevron 10 million, 20 million and 10 million. Chevron Limited financial statement showed a payable same amount. He recognized same amount as a payable. That's good. No difference. However, Unimo showed a payable balance of 15,000. 15 million means in thousand, 15,000. There is a difference of 5,000. Got it? There is a difference of 5,000. Reason for difference is 3,000 is cash in transit and 2,000 is good in transit. Then what you have to do? You have to debit cash, you have to debit inventory, and you have to credit payable, Unimo payable 5,000. Then cash in transit 3,000 debit, inventory 2,000 debit, Unimo payable 5,000 credit. That would be the double entry. If you go back to the balance sheet, you can see here inventory debit 2,000, cash in transit debit 3,000, and altogether I think payable credited in current liability, payable should be credited. Trade and other payable uh, included intercompany balance, it should be credited. Then within this and receivable balance become equal 20,000, 20,000. When you console, you can eliminate both balances, then it won't affect to the balancing figure. I think you got it, right? Generally, payable balance is 15,000, receivable balance is 20,000 here. Then you can offset two numbers, isn't it? First, you have to balance it. Now you put 3,000 to cash, 2,000 to inventory, credit into payable 5,000. Now both receivable and payable equal, then you can eliminate. That is the entry. Since it eliminated this balance sheet, you can't see those numbers, right? After balancing, you can eliminate, right? Now, finally, you eliminate 20,000 from receivable, you eliminate 15,000 from payable, and put 5,000 to cash and inventory. Balance sheet become balance. That is the end of the consolidation. Balance thing, I think you can easily put. You have to put the numbers and tally this balance sheet. Answer is there. You can go through once you get the answer, right? If you have any question on this, you can ask from me now before moving to the other question. Right. Seems to be no questions. Right. Okay, I will take question number 7 now. Question number 7 consists 3 questions. Number 1 is revenue recognition. Since you have the answer, I will explain how to answer. right? The directors of D Limited would like to know how to transaction should be accounted for under SLFRS 50. D Limited sales wind turbines as part of combined contract with include standard 2-year warranty term and maintenance services for 10-year period. In addition, D Limited offers the option of 10-year extension to the warranty for the additional fee, which is paid at the time of the initial sale. The sales price for the combined contract 3.6 million, and the customer will pay an additional fee of 0.8 million for the extended warranty. If sold separately, the selling price of the wind turbine is 3.2, and the selling price of 2-year warranty and 10-year maintenance service contract is 0.9 million. The extended warranty has a separate selling price of 1 million. Now, you have a bundle price here because they have generally selling turbine at 3.2, right? Then 2-year warranty cost is zero point 0.9 and 10-year warranty for additional 1 million. But when they are selling everything together, right, 3.6 plus zero point 0.8. Now there are three performance obligations. Selling turbine, right? Then 2-year warranty and 10-year warranty. In addition, for the another 10 year, they charge 0.8. Therefore, what you need to do, you need to allocate this price among each performance obligation. This 3.6 million price, combined price, charged for the turbine and the 10-year warranty. Right? Now you have to separate it. Here I have mentioned how to separate it. Here's the calculation. I will show it to the calculation to you, right? Then you can read the answer. Now look at the question. I have the question. I will read. I think you also have the question, right? Now see the total price. Company sells turbine as part of the combined contract, which include standard 2-year warranty term and maintenance service for 10 years period. 3.6, right? Now this 3.6 include three performance obligation: turbine, 2-year warranty, and 10-year warranty. For the other one, separately they charge. Now, if they sell it separately, selling price of the wind turbine 3.2 million and selling price of 2-year warranty 0.9 and selling price of 10-year warranty and the selling price of 2-year warranty and 10-year maintenance is 0.9, right? Now, if you add together everything, right, separate prices 3.2 and zero point 0.9, but when they are selling together it is 3.6. Now you can see here separate price for turbine 3.2, right, divide by total standalone prices, then you can see what is the percentage have for the turbine, right? 3.2 plus zero point 0.9 become 3.1, 31.1. Then I think I better to calculate it. Right, look here, I will do it for you easy. Now separately sale, right? I will write down. Selling price of the wind turbine.
I wasn't able to find the winter in your Apple Music library.
Turbine 3.2, right? Then 2-year warranty and 10-year maintenance. Warranty and maintenance 0.9. Additional warranty, additional maintenance 1. Right? Now let's see the total. 5.1 total. Now, how they have sold? They combine these two, because additional maintenance they charge separately. They combine only these two, right? Look here, I am going to combine. They combine only these two. Okay. Now let's see what once it combined, what would be the standalone prices? 4.1. But they have charged for both 3.6. Right? They have charged 3.6 when they are selling combined. Now what you need to do, this has to be allocated among turbine and warranty and main maintenance. You can separate this one because this is separately they have to agree, right? Therefore no issue with the last one. They have combined these two. Now how we can allocate? Turbine price is 3.2 out of 4.1. Then how much from 3.6? Again, 2-year warranty and 10-year maintenance is 9 from this. Then how much from 3.6? These are the prices to be allocated, right? When you are working your revenue recognition. 2.8 and 0.8. Here 2.8 and 0.8. They have taken into the 1 decimal place. Now this is called price allocation among performance obligations. What we have done, you can read the answer. I'm not going to read the answer. When you have a combined price for 2 performance obligation or 3 or more, first take the standalone price and take the total. Then divide combined price by standalone price and multiply it by separate prices. Then you can have the allocation of this combined price among 2 performance obligation. Right? Then once you sell the turbine, you have to recognize this revenue. Once you provide the according to you provide the 10-year warranty, 2-year warranty and maintenance, you have to recognize this revenue. That's you have to answer, right? The principle is here, when you have a combined price for many performance obligations, take the standalone prices and allocate that combined price according to the proportionate of standalone price if they sell it separately, right? The answer is here. You can read these theories and further understood your knowledge. I have gave you the basic understanding, right? Then moving into the second question, it is uh, impairment of cash generating unit, right? If I show it to you in my calculation quickly, how to do that? I think you already read the question. In this cash generating unit, they have goodwill, PPE, and other assets, right? They have carrying value in the cash generating unit 3, 10, and 19, right? Right. Now what you need to do, you have to get the recoverable value after impairment. If there is impairment, you have to get the value. Then here you can record any impairment. Right. Impairment is equal carrying value minus recoverable value. How you can calculate the recoverable value? Recoverable value equal fair value less cost to sell and value in use. Right. In this question, they mention fair value of the property, plant and equipment 10 million and other assets 17 million, cost to sell 100,000 and 300,000. Generally, fair value won't given for goodwill because goodwill is part of the other assets. We assume goodwill is in other assets. Therefore, generally, you don't have fair value. When they are valuing the goodwill, fair value comes to tangible assets 10 and 70. Right? Cost to sell 0.1 100,000 and 0.3, that is 300,000. Now you can take fair value less cost to sell, right, this, and total fair value less cost to sell will be, right, 19.6. These two, right, 19.6. So generally goodwill won't give any fair value. Then value in use. They have gave you cash flows, right? Especially LKS 36 clearly mentioned, when you get the value in use, you have to take pre-tax cash flows has to be discounted by pre-tax discounting factor. I think you can remember that. LKS 36 clearly mentioned, you have to take pre-tax cash flows by pre-tax discounting factor. Right? Pre-tax discounting factor is 8%, post-tax discounting factor is 6%. We have to take pre-tax cash flows and we have to discount it by pre-tax discounting factor. I will give you LK 36 paragraph, I think it's become 55. Impairment. Paragraph 55. Discount rate. The discount rate shall be pre-tax rate. Paragraph 55. Right? Then cash flow also has to be pre-tax. Right? Now you know you have two types of cash flows and discount rate. No doubt, take all pre-tax items and record it. Right? I will quickly put pre-tax cash flows. Pre-tax cash flows, right? For the 5 years, 8, 7, 5, 3, 30. Then discounting factor pre-tax, that is how much? 8%. Pre-tax cash flow, sorry, pre-tax discount factor is 8%. Then I can take like this, 1 divided by 1.08. Then this number divided by 1.08. Now I think it's becoming right. Discount factors, yeah. Now you can take the present value and you can take the total present value as the value in use. That is become 28.04, right? Now value in use 28.4, fair value less cost to sell is 19, recoverable value will be whichever is higher, right? whichever is higher. The higher is value in use, therefore that is the recoverable value after impairment. Right? Now you can see how much the impairment. This is the impairment 3.57. Right? Now how you going to allocate? No doubt, first you have to charge to the goodwill. Entire 3 you can charge to goodwill. Right? Then balance 57 can be allocated among other asset and PP on pro rata basis. How? Balance is 0.57 divided by 10 and 19 is 29. Right? 0.57 divided by 29, total of these two. Then multiplied by respective values. Now total impairment become 3.57. Right? If I got the total here, easily you can take this. Right? Now if you take this minus this, you can see it's become the recoverable value. Now you can take value after impairment after deducting each impairment from each asset. Right. This would be the answer for this question. Answer is there, you can read and understand. Right? Everything I have explained is in that at standard also. You have to write down those points what I have explained to you. Right? Now the last question. The last question is, D Limited prepares financial statement on 31st March year. 1st April 2022, D Limited began lease a property for 10-year lease. The annual lease payment was 500,000 payable in arrears. The first payment being made in 31st March 2023. D Limited incurred initial direct cost of 60,000 in arranging this lease. The annual rate of interest implicit in the lease is 10%. Explain and show how these transactions would be reported in the financial statement of D Limited for the year ended 31st March 2023. D Limited prepares financial in 31st March. 1st April 2022, D Limited began to lease a property for 10 years. Annual lease payment in arrears 500,000. Right? Now, as per the standard, you need to recognize right of use asset. Right? And the respective lease liability. That point you have to write down. As per the SLFRS 16, we need to recognize right of use asset and respective lease liability. Right of use asset consists 4 things. 1. The present value of the future lease payment discounted by implicit interest rate of the agreement. In the absence of implicit rate of the agreement, you have to discount it by the incremental borrowing rate. That is right of use asset debit, lease liability credit that present value. Thereafter, any initial payment made, cash credit, right of use asset debit. Any transaction cost incurred like here 60,000, right of use asset debit, cash credit. In addition to that, if there is any estimated dismantling cost, right of use asset debit, provision credit. That's how these two has to be recognized. Right? Thereafter, you have to depreciate the asset, right of use asset, the period of useful life or lease period, whichever terminated earlier, and you have to amortize the lease liability. Right? Now here, you have to take the present value of this 500,000, discounted at 10% for 5 years, You have to use the cumulative discounting factor because every year you pay this, and you have to debit the 60,000 also to the right of use asset because it's a transaction cost. If I take the answer here, I will calculate it for you, right? Better. Rate is 10%. Installment is 500,000, right? Let's take the present value. Cumulative discounting factor. How we can calculate? 1 minus 1 divided by 1.1 power 5 divided by 0.1, right? Then present value will be this 189. Let's see whether it is correct. Is that 10 years? Sorry, I have taken, yeah, 10 years. Sorry, I have taken 5 years. It is for 10 years. Sorry. Right. Now this is the present value. Right. Debit right of use asset, credit lease liability. That's all. Then again you have to debit 60,000 to the right of use asset. If I do the calculation again in T account format, lease liability is this much. Here you will record right of use asset, the same value. Then transaction cost 60,000 paid, cash credit, here debit 60,000. Then this has to be depreciated, right? They have not mentioned the useful life. Therefore, yes, has to be depreciated over 10 years, the total value, right? Total value is this 2 divided by 10 for the depreciation. Now you can get the carrying value at the end of the year, right? The lease liability has to be amortized, P&L debit, here credit, interest cost, lease interest cost, this on 10% because interest rate is 10%. At the end of the year, you pay the installment in cash, 500,000, right? Then you can take the closing balance as well in the lease liability. Those thing has been write it down here, right, as numbers. Now at the end of the day, this is the carrying value because out of 10 years, 9 will be there. If you take here, I will show you, right? Carried down balance would be this minus this depreciation 2819055, 28190, right? This is the value. Let's see, this is the value. Then direct cost lease be added to the right of use asset. Therefore total value will be 372,560,000. 372. They have taken 500 because I have used Excel. That's why you have a small difference, right? 60,000. Then divide by 10 for depreciation, right? Here, 1 year depreciation. Then carry in value. There is a small difference because of the decimal issue. Then this is the lease liability. 500,000 paid. Interest charge. Balance is coming. That's all, right? Okay. This is the end of the discussion. But I don't think within this 4 hour you can't be the expert in BFRG or accounting standard, right? This is just only a reminder. The areas can be tested or how to prepare for the exam, right? This won't help you to become a genius in financial reporting. You need to have continuous study, right? But this will help you. The areas can be tested. At least have an idea. I believe you have gained some idea on this, right? I believe. Then finally, I can wish you all the best and wish you are the exam coming in next week. Face for the exam with your fair mind, right? And the hard working